My name is Zakiya Smith. I'm a strategy director at the Lumina Foundation, where I lead our work on developing new models of student financial support. As part of that work, you heard our president, CEO Jamie Mirasotis earlier talk about our interest in models of financial support that can help us reach our goal 2025, which is similar to national attainment goals that have been expressed elsewhere. I just want to quickly introduce this panel and kind of give an overview of what we'll be talking about. So you heard in the first part of the day a conversation about all of these, not all of them, but many of the models in the private sector, and then one model in the public sector space, and then one nonprofit model of how these income sharing agreements could work, or as the hashtag for today, if you are tweeting, zero debt or zero education debt agreements, ZED, might work. And we heard from people that are actually implementing that in different scenarios. And what we want to do now is to have some kind of people who are more independent from the work immediately. Our one exception would be Miguel. Oh, you are also a professor at Vanderbilt University.
I'll introduce myself with my other hat.
Yes, exactly. So the first time he was co-founder of Lumni, and this time he is professor at Vanderbilt University. And so we've got, I'm going to let folks introduce themselves. I'm also going to sit down so that I'm not standing the entire time, but as Jason was, because I have on heels, and that's what we get to do. But I do just want to say that this panel will be a little bit more of an opportunity to dig in and look under the hood, as Jamie talked about, and ask some of the critical questions, I would say, from both sides. So I've heard really interesting arguments for these kind of models from the far left and the far right. And so I'm not sure of the political backgrounds of any of these people, but we'll hear about their thoughts of these programs. So just as a brief introduction, we have Rohit Chopra, who is an assistant director at the Consumer Financial Protection Bureau. They are an independent agency and are not shut down because they have independent appropriations that don't come through the regular appropriations process. Yay. Alex Holt, who you met earlier from New America Foundation. Miguel Palacios, who is an assistant professor at Vanderbilt University's Owen Graduate School of Management. And Michelle Asha Cooper, who is the president of the Institute for Higher Education Policy. So I'm going to start out this conversation by asking a general question. Given what we heard earlier today, and I'm going to ask to start with Michelle and then work our way down, do you find these approaches promising or not for the kind of breaking the kind of dysfunction that we talked about earlier, and why? And we'll start there, and then we'll kind of dig in deeper as we go along.
Okay, thank you. Thank you all for having this panel, and thank you for inviting me to be on it. I find the conversation very interesting, to answer your question. I think it's good that we have people who are trying to think of out-of-the-box solutions to some of the challenges that we currently face in our student financial aid and we are financing higher education in terms of the system and trying to make it more sustainable. So I think that that's good. I think it's good that we're having cross-sector conversations about some innovative type approaches. But the one thing I would caution us, because in the higher education community, we have a tendency to become fixated on the next big thing. And that worries me with this conversation and others like this conversation that I've been a part of, because we have solutions that are in place that we are trying to give time to work, but we have now started to dig into some other things. And I worry that, this could be the new shiny toy underneath the Christmas tree that we play with for 6 months and then forget that we had it, when Barbie still works just fine, but in a sense, if we're going to look at any solution, regardless if it's the new best thing or it's something that's already in existence, I think that we have to be consistent and be mindful of looking at these ideas through a framework. And the framework has to consider a couple things. The first is students. In Jamie's opening remarks, he talked about students being the center of all of these higher education reforms. And if we are not looking at students at the center of any type of reform and making sure that it increases their likelihood of success within the system, but does not negate the fact that we still need to get students into the system. So it has to be about access, it has to be about success, and it has to be about minimizing the risk for those students who we know we want to get into the door, those students who have been historically underserved. Also, we need to make sure that the reforms are making college more affordable. So I have to confess, I have a problem with the title of this panel. It's called Zero Education Debt. I think that's a catchy title. I think it raises people's eyebrows. I think it's why many people came, because you want to hear all about zero education debt. And if we write a story in the New York Times, people will read it.
Or political, yeah.
Yeah, or political. Okay. But it is not a free education, and it is not guaranteed free debt. And so we need to be mindful that that is not what is happening here. We have a system currently where there is a little bit of certainty about what students pay on the front end. They may not know exactly what their student loans will going to be, but they have a sense as they progress through the system of how much it's going to cost them and how much they're going to repay. On this new system, there actually is no certainty. You really don't know until you are on the back end, actually, technically, until you're finished paying, how much you would have had to pay. So, it doesn't have certainty. And with the system where we have students paying a predetermined rate over a predetermined amount of time, we actually could be making some students pay more than they would have paid under the traditional loan processing way that we currently do student aid. And as some of the people on the previous panel mentioned, we have not tackled the real costs about why tuition and fees and cost of college continue to go up. So this model does not do any of that. Secondly, the model is also not as simple as we like. And those of you who've been involved in conversations around student financial aid reform for several years, you know that over the last 20 years, there have been a number of efforts to simplify the process since the 1992 HEA amendments. Simplification has been a constant thing. And this process actually does not make things a little bit more simple. It actually makes it a tad bit more complicated, because you could have students paying through two mechanisms. They could be getting their tuition and fees paid in the pay-as-you-go, PIF, pay it forward model. You could be having tuition and fees paid one way, and then you still have to pay for room and board and other costs through a different mechanism. And for those of you who monitor college trends and pricing, you know that that's really where the big costs are. For students who are at a public four-year institution, 50% of their costs are through room, board, and those other living expenses. And for students at a community colleges, it's up to about 70%. So they still might have to pay for that expense through grants, loans, savings, work, and a variety of other strategies. And the last thing I just want to say is the foundation around shared accountability. So we talked about that a little bit in the first session. There's this investment in higher education, and what I worry is that these type of market-driven approaches to student financing pretty much let states and institutions off the hook for their role in making sure that higher education remains a public good.
All right, thank you. Miguel?
So is this promising? There's two components of it. One, as the question at the end of the last panel was talking about income-based repayments. And the world is moving towards income-based repayments. This was something of a weird idea 60 years ago, and when it was first proposed, before there were student loans or the federal student loan system in this country. But slowly the world has figured out that that's a better way to do it. And so income-based repayment, very promising. I think we're going to see more of it, and it's here to stay, and that's very good. I'm going to disagree with Michelle on one thing. It adds certainty on a very important dimension, which is on the percentage of income, on the burden that the debt is going to give me. I'm going to argue that having certainty about how much you're going to pay when you don't know whether you're going to be able to pay it or not is not really the certainty that matters. The certainty that matters is I'm going to be able to pay this. And income-based repayment shifts from a variable burden to a fixed burden. Very promising. Now, the second part is, let's call it the market-driven part, or the having private participants offering funding in a private framework. I find that also very promising, because it creates incentives that right now do not exist. Those two incentives that are very important are giving an incentive for people to choose a career that is going to allow them to have a higher earning potential, which, by the way, is going to be the same career that satisfies the skill need that employers have at a given point. If the goal is to produce the skilled workforce that the country needs, then it's better to have systems in which people have the right incentive to choose what to do. And so I find that very promising. I also find the great idea or the great incentive to allow people to contrast how much the value that a university provides or that a community college provides, rather than the cost that the community college has. A community college or any higher education institution can be extremely expensive, but that's not the measure that we want to look at it on. We want to look at it on how much value it adds. It could be very expensive, but if the value is big, we want to make sure that students go that way, even though it's expensive. On the other hand, we can have very cheap colleges, but if the graduates of those cheap colleges don't make any money afterwards, we don't want them going there, right? So the instrument is promising in the sense that it gives these incentives for people to choose where they will develop valuable skills, and second, it will create an incentive among institutions to rationalize costs, right? Because it judges on value rather than just on cost.
Thanks, Miguel. Alex, promising or not? I have a feeling of what you're going to say, but I'm interested in why.
Well, yeah, I do think that it's a promising model. I would say that the way I came to this, I study income-based repayment a lot with Jason, and the more I look at traditional federal student loans, that standard 10-year term, the more I don't like it. I just think that I agree with Miguel that the most uncertainty comes from the fact that you know what your monthly payment will be, you just don't know if you'll be able to pay it. I would much rather be in a system where I don't know what my monthly payment will be, but I do know that I will be able to pay it. So I think that, I do think that income-based repayment is promising. However, I think that income-based repayment does lead to some weird incentives for schools to potentially really drive up costs for students to become price insensitive. The thing that I really find promising about the models on the private side is this price signaling mechanism that Miguel alluded to. People have been saying that these models don't address the cost issue, and I think that you need to kind of switch the way you're thinking about that a little bit. It doesn't address the cost issue directly, but it addresses the value issue. We want students to be going into high value degrees where they're served well. And what's so great about these models is that the investors only win if the students go do good things, if they go to good programs that prepare them. So that's not really necessarily true with a loan. With a loan, you just care if they get the loan or not. So I do find them promising. I also find the Oregon model promising because I just think that people really don't like debt. It does get rid of that price signaling, though, which I do think is kind of the most promising aspect.
Rohit?
So, Zakiya, you'll understand this as a former government official. I'm not going to answer your question directly, but I'll share some perspective from a banking regulator. So to give you a sense of where we come from, the CFPB is 2 years old, formed from the Dodd-Frank Act. And one of the things that happened 2 years ago is that authorities for oversight and rulemaking consolidate from a long alphabet soup of agencies, from HUD, the Federal Reserve Board, the FTC, many others, and for consumer financial products transferred to the CFPB. So over these 2 years, we've literally met with hundreds of entrepreneurs to figure out how they're able to bring their products to market in ways that are transparent and fair. So I have to say, a general comment about this sector has been very interested in figuring out how to do this in a transparent way and one that is adherent to principles of fair lending. Now, that being said, we will try and figure out how this market can function in a way that is transparent, but I will speak to some of the challenges that I see in really bringing it to scale. And it may not need to go to scale. This may be a portfolio of options that students and their families have to figure out how to finance education. So, To make it large scale, there really are some key policy choices or key program design choices. And I think one of these dimensions is, is this really going to be driven by public capital or private capital? And the other dimension is thinking about, is this 100% participation or is this voluntary opt-in? And as I think about the permutations between both of those two key design choices, one of the things that will really need to be ironed out is how do we address what could be some distortionary behavioral effects. Now, I actually think this is not some hugely revolutionary concept. In fact, in the financial services industry, we deal with this all the time about whether to choose to fund something through equity, debt, or something in between. You could really create a financial instrument that is very much like this economically. It would be some sort of cocktail of a convertible bond with a derivative hedge. But there are ways that you could think about this in other markets.
Students to understand.
Right. In other markets, we know that in real estate and insurance, some of these key issues about pooling, 100% versus voluntary, public or private capital, and how that would be risk adjusted. These are tough design questions that each have potentially different behavioral distortionary effects. So, and it could be something about how do you really deal with how this might affect the way someone deals with interstate labor mobility, if this is really a state-based program. How do we think about income recategorization? So, for example, if someone were to start a small business, could they end up assigning a large amount of their income to their spouse or their child? How do we deal with some labor market mismatch issues? Could it actually incentivize professions that have very bimodal outcomes, either failure or major success? And how might this change the incentives for state legislatures? All of these really have to be thought through if this is something that will go to scale. And it will be complex, but any solution to really a very problematic and non-functioning student debt market is going to be tricky. And we really need to confront that. And one of the ways that I see this as an interesting niche right now is we know that the student loan market is, even with private actors, not very competitive. It is very challenging for people to refinance their loans. And I could see a way in which this product has a near-term success for borrowers who are leaving school and making a choice between their federal income-based repayment options or to a different type of financing structure. This could be very transparent. This could be something that there may be a lot of market demand for. And I guess I'm very hopeful that there will be disruptive entrepreneurs and business models that can make the market function more robustly.
All right, so I think we kind of talked about some of the key issues. I'm kind of thinking about what's the next best place to go. We talked about price actually in the earlier panel. One of the key questions that everyone seems to have is that I will kind of raise back up, and not everyone has to answer, but do we have an issue where students are not sensitive enough to price or maybe value? I like the term value, as some may know, Miguel, in thinking about how students finance college. Does this really send a signal about choosing a college for value, or does it further remove students from that decision? So if you're just paying, and this is true about income-based repayment kind of almost in any form and not particular to any particular type, but if you're thinking about just your monthly payment, are you less inclined to kind of choose based on cost and quality than you might otherwise be? And is that something that's okay to give up that piece for the security of knowing that you'll be able to pay it per month? Is that something that we should be concerned about, or should there be some other mechanism in place to protect either the government or state governments or someone else from the price actually or the cost, depending on what you're thinking about, creeping up?
So suppose you're a student. So let me paint a picture of how this could look in 30 years. hopefully, maybe we don't get there. But suppose that that this became mainstream, and so you are an 18-year-old, and or 17-year-old, and you're thinking what you're going to do for studying college, and you get aggressive marketers. So that's going to happen. We don't like them, but there's going to be some of those. And then you're also going to see in boards something that says, go to Harvard, pay 5% of your income. And then next to it, there's another board that says, go to your local community college, pay 7% of your income. That's a very strong message. I'm assuming there that Harvard is good value, and so if there's Harvard grads here, that's good. But we could do it the other way. We could say there could be someone that says, hey, if you go into this Ivy League institution, you're going to pay 7% of your income. If you go to the community college, then it's going to be only 3% of your income. And so the discussion has nothing to do with how much it actually costs to go to the Ivy League or to the community college or to any other new form of higher education that springs up. The discussion is all about what percentage of your income are you going to commit afterwards. Think a little bit of in the way that some people do, at least, choose where they live based on their state tax, right? So this provides an incentive based on how much will you have to pay if you go one way or another, and it completely removes a big concern right now, which is how many thousands of dollars do I have to commit to something that is very easy to understand, which is how much of my income I'm going to have to pay if I go one way or another. And in that world, engineering, a computer science degree that is going to help Google find the people that they need is going to be offered at a much lower percentage of income than a degree that is not finding a job upon graduation. Those are going to be offered at a much higher percentage of income or not at all. And that's the incentive for value that I'm talking about.
I agree with Miguel. And then on the IBR side and with pay it forward, because there's not the price signaling mechanism, I think that you just need price controls. So you either have the private side that is doing this thing, or you have to have some type of price control that can be in the form of loan limits for IBR, or for pay it forward, the legislature just caps how much they're going to pay for it. But those to me are really the only two ways. Otherwise, you get into a situation in IBR.
It looks different depending on this is where it does actually look different depending on what the construction is, right? Like if it's a public system in which there isn't the investor control over kind of pricing or underwriting, if you will, the kind of investment at each college, that makes a difference.
Well, I argue that they do some underwriting. The question is how. So pay it forward will do some underwriting. The question is how big or narrow is the unit of analysis, and so so if you choose a very wide unit of analysis, so any student from Oregon that shows up, and we look at the averages from Oregon students, there's going to be some advantages and some problems. If we look at a very narrow unit of analysis, even if it's public funding, universities could choose to do that. And if you do a narrow unit of analysis, you're going to get some incentives. So if you do a narrow unit of analysis, you create this incentive to go to the place that has the highest future potential, right? So that's all that Pay It Forward would have to do to say create an incentive for the computer scientists. That question is not a public versus private. It's a question of whether the private or the public entity that decides to do it chooses a wide or narrow unit of analysis.
And if they do it at all, like it's hard to believe a public system really discriminating that much between degrees, right? I mean, I don't know. I have trouble seeing that. But.
Well, Miguel is from Latin America, so that's. No, I'm serious. Like the international perspective on these issues and whether or not you're thinking about what happens in America versus what happens in other countries is very interesting, and it maybe causes us to expand our perspective a little bit about what's possible in a public setting.
Right. So I have to confess, I don't no longer remember the exact wording on your initial question, but
that
more,
price and cost?
but more so in response
you
to
still have
these
something
two.
to say?
Yeah, I
You
still
were
have
saying.
something to say. So to Miguel's point about, telling students that you will pay a percent on your income, I agree that that's a very simple message that's easy to deliver. But what I'm concerned about is that it is not a guaranteed message that you can consistently deliver. So just taking us from using the public sector, for example, these funds would have to come from somewhere. In the case of Oregon, for example, you'd have to get the money to upstart somehow. And over time, let's say, for example, that those funds would have to be appropriated through state governments. And given what we see in budgetary battles in DC and across this country, I am not convinced that each and every year the state will guarantee a certain level of appropriations where you can always say that that fixed amount will be what you will pay for those 20 years or so. So it could be variable. The state might say in a time when there's a hard economic times that we are going to increase that percentage because we need to get out of an economic situation. So I don't feel that, I'm not convinced that the message is as clear and as simple as we believe that it could be. And so with that, I feel like these tools could be far more riskier for students than what we currently have through our student loan system, because at least with student loans and IBR, what I think people may have heard me wrong. I think IBR is part of the current system, so I think there's a lot of certainty in that. I think that there's not as much certainty in some of these newer models. They just haven't been tested yet well to figure out. But if we just look at what we have with the loans that we offer through our current system, we have a variety of consumer protections, whether it's protections for deferment against unemployment or disability, or we offer student loan forgiveness. We have protections in place for students when there is variability in their life circumstances. And I'm not hearing enough about that in these newer models to be convinced that the message that we might deliver on day one is a message that they can count on 20 years later.
So Zakiya, what I'd add on this is that in the contemplated set of principles around the model are trying to address what I think is a broader education policy issue, which is a real severe issue of labor market matching for college graduates. So I'm deeply disturbed at the data even prior to the onset of the financial crisis, where from 2000 to 2007, and if we continue to look through 2012, the growing college wage premium is completely explained by the reduction in wages by non-college graduates. It is not due to significant increases in starting wages from college graduates. Of course, college graduates will earn so much more over their lifetime on a present value basis, of course, but costs have increased more than the starting wage has increased on a real basis. And I think much of that, there's many hypotheses for that, which programs people are choosing, but also labor market matching. And so if there are ways to give cues to borrowers and students about how they might be able to choose a profession that would be more likely for them to get wage growth and be able to comfortably retire their debts, that seems like a worthy public policy goal.
So we're starting to get interesting questions, but we'll do questions from the audience in about 5 minutes. No, it's fine. I want people to be percolating and have ideas, but I have like this long list of questions, so before I give it to you all, I'm going to get some more of mine in first. One of those is around kind of an assumption that I've heard, and I'm on Twitter, and we should have said that earlier. We didn't already, but at Smith Zakiya, and one of the things that came up earlier as I was trolling for additional questions is the idea that these types of agreements will kind of cure debt aversion. And I'm intrigued by that concept, but I think we kind of state it as a fact. And I'm wondering if we know for sure that students will feel, and maybe just that they are more willing to go into an agreement where they're paying a fixed percentage of their income. Well, they feel like that is not a loan. It's not a loan because it's not something that can be paid off in a certain amount of time. But do we know for sure, is that just a theory that we have that we hope plays out? And I'm asking kind of because I don't know if we have any research on this, and I'm kind of trying to figure out if it's more promising because of that? Is that one of the key things that we think is useful about models like this? And if so, do we know for sure that that'll work?
So I actually have done research on this. And
This is why you're on the panel.
so we took a group of students and we confronted them with different types of contracts. The key idea behind the experiment that we were running was to see whether contracts that have exactly the same payoffs, if you label them differently, the attractiveness of the contract changed. Mm-hmm. And so this is a working paper. It was published by the World Bank, and what we found was very strong effects. So you take two contracts that are exactly the same, and you to one group of students you say, oh, by the way, this is called a contract, and to the other ones you say this is called a loan, and they're much more likely to prefer the contract rather than the loan. And then we tested a little bit something forward. We also wanted to see whether the name loan, because debt aversion it could be that there's something about debt so something of the characteristics of debt that people don't like, or it could be that they don't like the word debt. So if you grew up with the idea that having debt is bad, and we just say, oh, well, let me give you this other thing that is not called debt, but it's the same thing. So that's what we found in the first part. In the first part is oh, you don't like debt, so let me give you, a contract, and they prefer that more. But then if the other thing we wanted to test is whether you change the framing so that in one case you say, well, here's some debt, but this debt is going to have low income forgiveness, which is a little bit the way that the U.S. treats its income-based repayment, right? So you have to pay your debt, but if you have low income, you're going to be protected. Or we gave a different group of students a contract that said, look, you're going to pay a percentage of your income, but you're not going to pay too much. So if you do really well, we're going to cap your payments. It so happens that those two things have exactly the same payoffs. That is, if the student does poorly, they only pay a small amount, and if they do really well, they pay a fixed amount as if it was debt. And they preferred the contract that was framed as more like as an income share agreement rather than as debt. So is there do we have evidence? My research, by the way, is not the only one that has addressed this question. It's the only one that has addressed it in kind of in a precise way with two payoffs that look exactly the same. We do see that people don't like the idea of holding debt or having an instrument that is called debt. And so if one can move away from there, then we think that that's a good idea. Now, the big thing about income share agreements is that the nature of the contract is different. The nature is completely different from debt. That is, it's more a sharing agreement, and so do we think that students prefer to share their income so that if they do bad, they have to pay little in exchange of paying a lot if they do well, or do they prefer having a fixed amount so that they they're on the hook if things go bad, and it's very easy to pay if things go well. That part, I think the theory is very strong on what one would prefer. I would imagine that in the audience, most people would prefer the sharing part rather than having to be on the hook if things go bad. But that research is that has been shown in many different settings, not in this particular setting.
Yeah, one interesting thing that we see in the post-financial crisis data is that you would anticipate the levels of first-time homeownership amongst young college graduates to actually be higher. So even when we think about student debt, there can be two sort of psychological effects. One is the cash flow effect. So do you actually have the ability to be liquid enough to make required payments? So this is something that IBR actually addresses quite well. There's the principal effect, this is kind of that albatross effect of that, wow, I owe this big amount, even though that I'm able to pay it, I feel it. And so there's recently some good survey data from the National Association of Realtors that asks prospective renters who want to buy homes, what is really the obstacle that you face? And they just posted an option of student debt as a reason, and it scored as one of the top reasons. And it's maybe even disconnected from the ability to qualify for a mortgage. Many people could qualify, but they felt that debt was an obstacle to them. And so one of the things that is intriguing from a behavioral economics point of view is, how do people price in what is a principal burden and trade that off, which could be more similar to what might be a tax or some sort of marginal additional payment.
Any other on that point?
Yeah, I just wanted to, I am interested in your research. I thought as you were talking, I'm like, yeah, if someone asked me, do I want a debt or a contract, I'm definitely going for the contract for sure. And so it makes sense to me that that's how students would respond to this as well. And you know, I think we should call things kind of what they are. So we're saying that with these newer options that it's not debt. And that's fine if we want to say that. But we have to recognize that students have to repay something.
They're not repaying, they're just sharing their income for a specific amount of time.
But they're giving somebody some money for something.
Well, I know. I think the thing that's realizing why it's not repaying is because if my grandmother dies and gives me $20,000, you just take 4% of my $20,000 and then whatever next year too, in the pay it forward model or something different. You can't. I didn't borrow a certain amount that I can then pay off.
Right.
Which when we say repaying makes it sound like that. In sharing, I'm just sharing for a specific amount of time.
Whatever you want to call it.
I don't know what to call it.
The
It's
fact
not-
is, somebody's got to give some money to somebody for some reason.
Yeah, it's an obligation.
It's an
Obligation,
obligation.
I think.
Okay, it's an obligation.
Obligation.
And I think
Yes,
when you're
obligation.
talking about, you know, let's just talk about low income, moderate income students, I think they will still view it in a similar way. They have to pay money for a service that was rendered at some point. And we just need to be mindful that we want to be giving people accurate information because we want them to make good decisions and decisions that will optimize their life chances. And all of these things that we're talking about is really about how to change students' behavior in order to go to college or maybe take out or participate in a particular program. But the real issue is affordability. And none of these solutions are really addressing whether or not college is going to be more affordable for more students.
I disagree. The real issue is not affordability. If it's a good investment, it could be, you know, $2 million investment. There's someone who is going to be willing to fund it. The true issue is there's a valuable investment that is not finding the capital to do it on one hand, or on the other hand, there's a costly investment that has very low returns because the person who takes it doesn't find a job. It didn't help in any way that it was affordable for that person to go and get an education that was worthless, right? So I think I disagree. The key issue is if there's someone who can invest in themselves and do much better in the labor force afterwards, that person needs to be funded. The issue is that person is funded. The issue is not everyone, regardless of whether they're going to throw away money because they're going to end up with a degree that is useless, should afford it.
I think just to bridge something that Michelle and Miguel are trying to say is that there's other analogies to this, which is one of the great issues that a number of cities and states are dealing with is funding of mass transportation. And one of the key things that they think about is, are we going to fund this with tolls or transit fares or with public bonds or taxes? And really, you're making a choice between is the public bearing it or are the users bearing it? And one of the things that really needs to be considered is that with new types of funding models, does it create momentum to push a system toward more user-generated funding, whether it be in the future or current, or more toward a public shared responsibility? So that's something that probably does need to be thought about And just like I was saying, it could have an effect on how state legislators think about it. It could have an effect on how individual students price it, and
That's a good analogy, yeah.
and that's something that we just have to confront. The funding model is in some ways separate, but could impact how the cost distribution between the public and the user falls out.
So I'm going to take something from Jason that I thought was fascinating, which was the rapid style questions. And what I'm going to do is, I have two more questions that are my personal questions, but I'll just state them, and you can percolate on them while we ask the other question. The first is a question and a comment, and that is, are these different does this look different if it's an 18 or 17-year-old versus a 35-year-old? Because we've been talking a lot about an 18-year-old, and what we at Lumina really, really try to stress is that in a growing way, most of the people that we're trying to help get increase attainment, have some college no degree, maybe we've already been in, or we're trying to get them to re-engage in the system in some way, or engage in the system after the kind of initial period when the traditional student did this, would have. And I think that makes particularly a difference if we're talking about the time horizon of some of these things. So whether you're paying over 20 years when you're 35 is different if you're paying over 20 years when you're 18, and the life choices that makes. And so I know some of the actuarial stuff is being done on some of these models, but I don't know that we've adequately addressed that question. And similar to that, but not the same as this issue of adverse selection, which we kind of touched on, but not really gone into a great detail about, which goes in both directions. So it's actually interesting, your question, this adverse selection works in both ways, right? Like, so some people may prefer to do the security of doing that. On the flip side, you may opt out if you have the ability to opt out, if you think, for instance, that if you have the high level of confidence that you're going to be the next Steve Jobs, I guarantee you don't want to share your income for the next however many years. You'd rather just pay whatever it is up front. And so as you were talking about, I was like, I actually wouldn't prefer to share my income. I'm very positive about my income, over the next several years, and think I'm fairly young and, whatever. And I would rather just pay whatever it is. But that's me, right? Like, and so the question is, do we have any kind of research about who would make those types of choices, and does it incent the type of behavior? And maybe it's okay that I would prefer that because you're the type of person that you want to force me into the plan anyway. But I want us to think about the adverse selection on both ends as well. Questions from the audience. Do we have a mic somewhere? Okay.
Hi, Jeff Stroll, Georgetown University Center on the Education and the Workforce. Two quick questions, one to Miguel. You seem to be talking semantics at this point. You're talking about the difference between a contract and a debt, and you have no idea in a repeated prisoner's dilemma type context how the reputation effects are going to come, and I think that's what Michelle's point is. You're going to be paying a monthly payment, either it's to debt service or obligation service. So how does the difference in income sharing change long-term behavior? The second question that seems to keep getting sidestepped, which goes to Alex, is really about cost. I'll put this in the form of a hypothesis. The private market has very short time horizons. What you're talking about is going to squeeze out socially valued but not economically valued programs. For instance, school counseling psychologists earn $29,000 median earnings with the BA, primarily an African-American female job. Petroleum engineers start at $120,000. So if we have a in-demand occupation, the wage inflation is higher than cost inflation. You're enabling institutions to continue to take rents by increasing costs just slightly less than the wage increase, while the neutral wage increasing profession gets squeezed out because of cost. So you're not covering that at all. You might not be meaning to. So that's sort of my hypothesis. Do you agree or disagree? Thank you.
That is the best, most complicated two questions within a minute time frame that I've ever heard. Who would like to start with that?
I'll let Miguel start.
Okay, of course you will.
So to the first question of do we know whether income sharing will change student behavior? So the truth is, because there's not a lot of history of this, we cannot say we know what's going to happen. The theory does tell us some things. We think they're going to be willing to take more risks, and that's something that Dave brought up. And the idea is, if I don't have this fixed commitment, then I might be willing to gamble more. Now, this gamble is valuable for society, right? We want more entrepreneurs trying more things, so the willingness of taking more risk is a good thing. It's not a bad thing. And right now, that's not happening because these people are not willing to take the risk because they have the fixed obligation. So I think that's a long-term change that should happen, and I'm looking forward to it happening. Now, as for the second part, so left to its own devices, you're totally right. So the fields that would get the better funding are the ones that provide the most private value, not public value. And so you came up with an example that is most likely one in which we agree that there's high public value, little private value. That so these people that are being paid so little are clearly providing a service that is worth much more than what they're getting paid. And that's why I would never advocate a private-only system. There is in higher education lots of public benefits, and that's one of the reasons why there's a justification for public education or publicly funded education. And what these agreements would do, though, is that they would increase the efficiency of the use of those public funds. Because right now, there's public funds going to those who get the high public benefits. To those who need it because it's a high public benefit, low private value. But they're also going to the engineers who, basically, the society is subsidizing very well-to-do engineers. That should not happen. With these agreements, you would move towards a system in which the engineers who are to the most degree are people who get mostly private benefits, get to pay for those private benefits, and then you have some resources freed to fund those professions that need the public funds because they provide public benefits, and that's the way I think it should go.
And just to add on, thinking about it a little differently, I understand your point about rent seeking, although I would say this, I'm not sure that it is the job of higher education financing to right every single wrong, in the sense that school counselors should probably be paid more. I'm not sure that you want to use the higher education financing system to right that. You could just pay counselors more. The second thing I want to say is that some people are willing to take lower incomes and slightly higher rates in order to do what they love to do. And I'm not sure that we should rely on the higher education system to do all these weird things with the market there. And the third thing I would say is this system, in my mind, if it were at scale, only works with grants, direct grants. And the reason is because what we're talking about here is if the government wants to step in from a social good perspective, the best way they can do this is to allow these types of agreements to exist and at the same time say people who are going to become school counselors should get direct grants. That will directly decrease the the rate at which the person would repay. So, I mean, that's sort of how I think about it. There's a social component. The government still needs to be involved.
But the point that I was trying to make is that your model with the free private market could actually enable cost escalation because it's going to be tied to wage inflation. So as long as cost inflation is just under wage inflation on high demand careers, you're going to enable costs. So your structure is not actually, I don't put responsibility to create a wrong, to right or wrong, but you actually might be exasperating a different
if higher ed costs were only increasing at the rate of wage inflation, I mean, I think that'd be awesome. Well, yeah, but I mean, so there's more value in it, right? It's a better investment. All right.
Dave in the front here. Yeah.
Sure. I sort of have a hypothetical question about a 100% public funded solution for the sake of argument, because I'm intrigued with the idea of can you get pricing signals and market needs, employment needs into that. So what if we said, my question to you is this acceptable? Is it from a political setting, maybe from a regular? Here's my question. Imagine if instead of when you go to your University of Oregon, you're going to pay back 3%. The starting point is as you begin there as a freshman, your fall year, you're actually going to pay 4%, which I think most of us would agree is not unreasonable if that's what you ended up as a burden to get your degree from University of Oregon. But if you choose to major in computer science, you're going to actually earn a 0.25% discount to that. And if you do really well, I mean, you get good grades because you're working harder than your friends who are out drinking beers. You're going to earn another 0.25%. And in the end, everyone who comes out of that school is paying no more than 4%, but some, frankly, are paying 2%. And by the way, because Oregon is a very forward-thinking state and cares a lot about teachers, if you're studying education, we're going to give you a 0.5% discount for that too. So to me, is there a way, or is it just fundamentally the notion that someone's going to pay 2% and someone's going to pay 4% so pernicious to be unacceptable for higher ed finance? That's my question.
So, can I take? Sure. So, in a theory world, yes, right. So we could have a centrally planned economy in which we adjust prices and goods so that everyone gets exactly that they would have gotten in a market economy. In this particular case, we could do it, right? So there could be a way in which Oregon, so the central planner in this case, would say, oh, if you go with that particular field, because we think it's going to do well, we're going to lower the rate, so we're going to give you the right incentive. So I think it can be done, at least in theory. The issue is who is making the decisions, right? So if Oregon is making the decision on what is the discount that goes to the teachers and what is the discount that goes to the computer scientists, what you're really creating is a bureaucracy that is doing the pricing of these instruments, a bureaucracy that most likely doesn't have skin in the game. When you have private participants, those private participants are doing the same thing that bureaucracy would be doing, right? That they're trying to figure out which are the fields that have the most promise, which are the fields that wouldn't, but they would have skin in the game. So the evidence in many other settings is that those people would end up doing a better job than the bureaucracy. The only part in which they would not do a better job would be with the teachers or with anything that is public value, right? Because then we are in the realm of a public discussion, and it's a more democracy discussion. But for everything else, you could in theory, but the reason I think that there has to be private involvement is that the private sector is going to do a much better job at doing the pricing than a bureaucracy that doesn't have skin in the game doing it.
It strikes me that we're trying to do a lot of different things with this model, which is, and so I'm just for, we don't have a ton of time in the rest of this conversation. I'll take maybe 2 more questions. I don't know when you'll kick us out of here. But
whenever you want.
Okay, we'll take 2 more questions, but I'll just say that we started this out trying to say that we have a national attainment kind of prerogative that we think more people should be getting high quality credentials. And so there are a number of things that you could do with this. You could try to drive people into certain fields. You could try to kind of fill in the gap from where states are disinvesting. You could, a number of different pieces of what this could be used for. But I would just encourage us as we leave here, and hopefully this has generated a lot of discussion, as you think about this, think about what is the model, because the question that Dave just asked, I actually thought about it in the opposite way. So I use this example a lot, and hopefully my sister doesn't watch a ton of higher education debates while she's at work. She is a petroleum engineer. She works for a large oil company, and she went to a really great engineering school. She made more money than I did when I got out of graduate school from her first year out, and she pays back no loans because we're from Georgia and we have the Georgia Hope Scholarship, so she paid nothing for college when she went to a public college in Georgia, which is great. Maybe she should be paying something because she's getting a lot of private benefit, and I'm not sure how much public benefit we're getting from her work, but a lot of private benefit. And maybe I should have gotten more subsidization for my education because, we don't value it as much in society. And so the purposes for these things and what you're trying to encourage, so are you trying to encourage, maybe you're trying to encourage more black women to be petroleum engineers, and therefore you want them to go to college for free, and you don't care if they make boatloads of money right afterwards, they don't need to pay anything back, or what have you. But I think we should just think about what is the purpose of what these programs are trying to do, because the construction of them really makes a difference depending on what you want the end result to be. Another question from...
And Zakia, one thing,
oh, yeah, go ahead.
I've been thinking about your adverse selection question, and just your example just now just brought it back, and this is a theory in my head. I think we've talked a lot about how students who might see themselves as potentially high-wage earners may opt out of the system. One thing we haven't really considered is the fact that, in the current system, we have parents who participate through putting forth some of their earnings and taking out plus loans. These models actually create a disincentive for them to participate at all. And so that's something we should be mindful of as well, because they have the ability to contribute, and then we let them take that money and keep it in their pocket. We just need to be mindful that that's a change in how we currently do things.
Thank you.
Steve Crawford, George Washington University. One more question for Miguel concerning, you gave the example of these 17 and 18-year-olds, presumably, who were asked whether they'd prefer a contract or a debt, a loan, and under certain conditions, et cetera, with equal payoffs. But that's when they're 17 or 18 and the future's very vague. But what about when they're 40 and now they've made a lot of money and they're beginning to resent paying a much higher amount back? Didn't we have some experience with this at Yale? And what can you tell us about how that might undermine the system over time?
So that's a great question. So first of all, from my research, I cannot answer that question because it was only young students. But from let's first clarify what Yale did. So Yale was a little bit closer to what 13th Avenue is doing, right? So the group of students as a cohort had to pay some debt, and as long as you were in the cohort, you kept paying a percentage of your income until the whole cohort paid. And that sounded awesome in 1972 when the program started, but by the 1990s, some people in the cohorts, and so the people from 13th Avenue, I'm sure, have thought about this. But please correct me if I say anything that is wrong. So by the 1990s, people in the cohort were saying, well, I'm happy to pay a lot, but I'm not. Why should I be responsible for the default of Alex, who is not paying his obligation? It's not that he's not making a lot; it's just that he defaulted, and so I say I'm actually willing to help Alex when he's not making a lot, but I'm not willing to help Alex when he defaults. Therefore, I'm going to default, and all of a sudden we have a cycle in which the people who are staying are paying for those who are defaulting, and that's seen as very unfair. So that's. I think the people from 13th Avenue are going to want to say something about it. So now from every time that that's a problem with the cohort model, and they should have a chance to say something about it. From the way, say, that the other companies are doing it, or from the way that I think it's best, is your responsibility for paying is only depending on you. It's not what the cohort does, but it's only what you do. And there can be some resentment. So here I can speak from experience of Lumni, because Lumni has had very successful cases. And we have different experiences. So one such experience is someone who says, I made all this money thanks to you guys, and I'm extremely happy because what I got is a gift, and paying 4% of my income is really nothing compared to what I would have made if I hadn't found the opportunity to fund my education. Therefore, not only I'm very happy to pay this 4%, I'm going to become an investor. So it's kind of pay it forward happening naturally with people who are grateful for the system. Then you also have, though, the case of someone that says, "Hey, I'm having to pay too much, and I don't like this," and so what I'm saying is you're going to have certainly some students that exposed are going to say, "This was a bad deal for me," and I don't think you can.
If everyone had to feel like it was a good deal, it might not work.
There's no way for everyone to make a good deal of it. The idea is...
Go ahead.
Yeah, this is why I think I mentioned the issue of insurance pooling before, because the insurance pooling, we all are in an insurance pool in any sort of healthcare plan, and it's a fact that the healthy people are subsidizing the sick. But the thing we have in our mind is that we one day may be sick. And one of the key differences in which there could be some distortionary effects here is that at some point, outcome is much more certain. So once you've hit it big, you've basically hit it big. And that's where I think the different type of psychological effect comes through. So as you...
Pre-existing condition when you know that you're going to need insurance, right? In some ways.
Yes, the fact that once you're more comfortable probably being in an insurance pool when you are still bearing risk.
Yeah.
And so and your risk profile is fundamentally different at age 17, 18 versus a person who graduates 4 years after, a 22, 23 versus afterward. And that's why I think in some ways we might see that the model works with a lot fewer distortionary effects when people have already accrued debt, have graduated college. Their likelihood of repayment is higher, but they may want to choose some different way of repaying it back.
Okay, what I would like to do is if anyone else from the panel has something on this point, and then go to 13th Avenue, and then we're going to have to close it out. Nope, okay, great, 13th Avenue, and then we'll close it out. No, we're live streaming, so we need you to use the...
I want everyone to hear you.
Casey Jennings, 13th Avenue. We looked at Yale real hard because that was sort of a model. We think they made a couple of mistakes. They had a lousy contract. We had this guy named Tonio Di Sorrento as our lawyer. We may be okay. The other part is they were fully joint and several liable for the full amount for time unlimited. So we've put in a hard stop in terms of time, no more than 15 years, and I think most people would sort of wrap their brain around it. We also put in a hard stop in terms of maximum pay. So we're at, once you pay 4x of what you were funded with, you're out of the program. So the combination of here's the amount, here's the principal, here's the hard stop, here's a contract that we think that works. We think we're going to avoid some of the Yale problems. We will certainly invent our own new problems.
Yeah, and this issue of contract enforcement is also a very key design issue, whether it's public or private. So, I actually think the way it could work out in Oregon might be actually very different than it could work in Maryland. Yep. So if we have to think about things about interstate labor mobility. Does the state of Oregon have the ability to assess this sort of for tax or obligation when the person does not reside in that state anymore, or if they reside abroad? Mm-hmm. And there's other ways, as if it's a private contract, that enforcing it is going to have different set of challenges for private investors, which might require a high risk premium for them. So there are a lot of tricky design questions that go into this.
I think the thing that I'm clear of after this conversation is that there is a lot of kind of design work that's really important, and the outcome of whether we think it's a good thing or a bad thing depends on that design. Mm-hmm. And whether it meets the goals that we have certainly depends on that design. So I want to thank all of our panelists for engaging in this kind of very complicated conversation at times. And I want to encourage all of you in the audience, thank you for coming, and I want to encourage you to kind of keep up with this conversation, continue to percolate on it, and if you have thoughts, we are kind of open to continue conversation about this, which was the goal of this event. Thank you all.